The Bank of England holds and says it will cut rates within a month or two. Malaysia's central bank is more upbeat about growth as it holds. China's exports rebound, and in the Philippines, soft consumer spending drags on GDP growth. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ New Zealand senior economist Miles Workman looks at the uncertainties surrounding New Zealand's housing market right now and how developments in Auckland might affect the rest of the country.
We've been surprised on the downside for prices in the first quarter of the year, and those forward-looking indicators, and in particular that sales to listings ratio, that suggests there's a bit more softness to come.
But first in 5 and 5 with ANZ, the Bank of England's rate-setting committee decided 7 votes to 2 overnight to hold its official cash rate at 5.25%, but signalled a rate cut is likely within a few months, as long as it sees wages inflation slow down as forecast. Here's ANZ Head of G3 Economics, Brian Martin.
We've had August in for quite a number of months now, so I think that's still a very realistic probability. But the Bank of England has put the market on alert. I think it's just now about the pace of the data improvement rather than will they be cutting interest rates at all. They definitely will.
Markets were quiet overnight with not too much movement in stocks or treasuries. And we saw the Australian dollar up around 0.5% to 66.14 US cents, and the New Zealand dollar up 0.4% at 60.28 US cents as of 5 a.m. Sydney-Melbourne time. Number 2, Malaysia's central bank also held rates yesterday at 3%, as expected. ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, says the tone of the Bank Negara's commentary was more upbeat.
The central bank pointed out to the fact that the global trade cycle is turning up, and secondly, it feels that the realization of FDI projects that have been approved is likely to be stronger. I think that it will be too early for them to pivot, given that the ringgit has until recently been under pressure. And secondly, even if you look at the magnitude of rate hikes, Malaysia rate hiking cycle was fairly mild.
Number 3, GDP growth in the Philippines was lower than expected in the March quarter, with an annual rate of 5.7%. That was higher than in December, but lower than the consensus for 5.9%. Sanjay says softer consumer spending was the main drag on growth.
Right now, given where the Fed is, it would be difficult for them to initiate rate cuts at this stage. That said, we also feel that this is a healthy adjustment in the economy because 2 of the problems the Philippines faces is elevated inflation and an elevated current account deficit. Therefore, a cooling off in domestic demand would help in correcting these imbalances.
Number 4, China's exports rose 1.5% in April from a year ago, slightly higher than the consensus forecast, and reversing a fall in March. Imports were up 8.4%. ANZ senior China strategist Zhao Pangjing says the ongoing export outlook is upbeat, but it's not solid.
The recovery of manufacturing activities at this moment are mainly driven by the restocking efforts in advanced economies. So we see China exports may rise further, but the persistency will be a problem. If this is the case, we still see that policymakers will step up with domestic stimulus in the second half of this year.
Number 5, China reports CPI and PPI data on Saturday. Xiaopeng is expecting the CPI to show annual growth of 0.2%, up a touch on last month, and the PPI to be down 2.5%, which would again be a better reading than March. Both were due to higher domestic oil prices.
We expect inflation momentum will be highly dependent on domestic pork price cycle and external Fed tightening cycle. For a domestic pork price cycle, we expect it will restart at the second half of this year. So given this, we expect that for 2024, the deflation risk will still be in the economy. China may see good inflation momentum in the next year.
Zhao Pangjing there. Now, in our bonus deep dive interview, ANZ New Zealand senior economist Miles Workman says New Zealand's housing market is very uncertain at the moment He sees Auckland as a bellwether for the rest of the country.
So the big picture terms, we've seen essentially the housing market trend a little bit softer than expected over the first quarter of 2024. That's been particularly evident in a number of timely indicators. So, for example, inventories of houses available for sale, they've been drifting up over the past few months, and in fact the month of April showed a further upwards tick there. So there's a bit more housing stock sitting out there. At the same time, sales remain below their normal levels for this time of year. So that those two things together do indicate a loosening trend in terms of price pressures. And in fact, we can actually take those two indicators and compute the sales to listings ratio, and that generally gives us a relatively good lead on where price momentum might be heading. So we've been surprised on the downside for prices in the first quarter of the year, and those forward-looking indicators, and in particular that sales to listings ratio, that suggests there's a bit more softness to come. Now, I'm not talking persistent negative house price changes going forward, but what this does suggest is very limited upside momentum. So I certainly wouldn't be surprised to see a couple of months where the house price index falls on a monthly basis, but at this stage it doesn't look like we're going to see persistent falls. Our forecast is for a relatively slow, modest growth over 2024 as a whole. We expect prices to rise only 3%, which is certainly well below the historical levels.
Can you talk about how Auckland has become a bellwether for the rest of the country?
We do often see the Auckland market lead other parts of the country, and sometimes it gets described as the halo effect. You might see Auckland market take off, and then as prices in Auckland look pricey relative to surrounding regions, those surrounding regions may see some catch up in price momentum. So it is quite handy to look at the Auckland market and sometimes trying to gauge whether or not that's going to give us any steer on where housing momentum might be heading for the broader economy. The other good reason to think that Auckland is a good lead market is that it does also tend to get its fair share of international migration. So, for example, in the year to June 2023, Auckland's population grew by more than 3% year on year. It certainly outpaced every other region that we have data for, and the lion's share of that growth came from inward migration. So Auckland getting this essentially a bunch of extra migrants certainly puts pressure on housing. We see that reflected in the consents data. So consents in Auckland are also a relatively large share of total consents in New Zealand. But the upshot here is both in Auckland and nationally, we're just not building enough houses to keep up with that demand. So then the big question becomes, are prices in Auckland essentially seeing that reflected in house prices, this huge demand from migrants? And the answer is no, and that's a bit of a surprise. I mean, there are certainly, Auckland has its own timely indicators. A good one that we like to watch is the auction clearance rates, and they've actually been trending modestly southbound in recent months. So that suggests that despite this very strong surge in migration and the impact that has on housing demand, house prices are still going against the grain of that at the moment. So I think there's a lot to unpack here when we think about the housing market in general. There are certainly lots of moving parts. So migration is only one of those parts. In fact, when you think about the big macro drivers, I think the two key factors that really matter right now are mortgage rates and the rising unemployment rate. So on the one hand, we do see scope for fixed mortgage rates to start falling from here. In fact, they already have started to fall, and that reflects wholesale markets pricing in OCR cuts from the Reserve Bank over the next year, over the next 2 years, etc.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, May the 10th. Catch you next week with detail from that Chinese price data and a preview of Australia's budget on Tuesday night. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.